to this third lesson of getting started in technical analysis. Today we will be talking of Charles Dow theory. This is important because he developed the theory almost more than 100 years ago back, and those 6 principles of Dow theory are almost the foundation of the technical analysis. This is the reason why it's important for us to understand Dow theory before moving more in detail into technical analysis. Again, let's get into this presentation. Let's talk about those 6 principles. The first principle is exactly the first principle of technical analysis, that the market or the price of a given market discount everything. All the information that can possibly influence a price of a market, like politically, fundamental, psychologically, like a war, like a crisis, it's already reflected, discounted in the price of that market. So it means that whatever is happening around us, it's already in the price. It's already reflected in the price that we see in a chart. So through the use of chart, what do we do with technical analysis? We are going to study the price movement. Now, the reasons why the price is moving is fundamental analysis, and the fundamental analysis studies the reason why all those external information are changing, moving the prices. What we want to know is more technical analysis, so we want to see just the price moving, and studying those price movement, we can predict the future price. And that, again, perhaps a better example is with the virus. We have a virus today. The price of oil went down because there is a virus, but the price is, if without knowing that there is a virus, we just open the chart, we see that the price goes down without knowing that there is a virus. So we don't need to know that there is a price, because we study the chart with the price, and that price is going down because already has taken in account the virus, whatever is happening around us. So the price is moving on the chart because something externally is making it move. We don't want to know the reason, but we just want to see the price moving in that chart. So again, to give a better understanding, the markets cannot anticipate events like a war or a virus, but they quickly discount such occurrences, and the effect can be seen almost instantaneously in the prices. So again, whatever is affecting the supply and demand of a given market, it can be seen in a price movement. So we open the chart, we see the price goes up and down. The reason we leave the reasons to the fundamental analyst. We just want to see the price is moving, and based on this price movement, we will be able, through the use of technical analysis, to predict the future movement of that price. The second point is almost was meant for real and industrial averages. Both of them, they should have the same behavior. So before investing in one market, the idea is just to check if there is a similar market, and to check some similarities. When both markets are perhaps they have the same trend, that is uptrend or downtrend, so we are more confident that so we can invest in that given market. So perhaps if you want to invest in Uber, just have a look at Lyft. If Lyft is moving in the same direction Uber, we are more confident that this is the right direction, the right trend direction. But if Lyft is doing something different from Uber, we need to stop and think why Lyft, that they are the same company, is doing differently from Uber, and try to do more research and try to understand why there is there are those differences between the two markets. Another example can be for the North Sea crude oil and the West Texas intermediate, so as a well-known WTI. So this is the concept. That how can we apply this concept to today's trading? Let's see the number 3. The number 3 that the Dow theory says that there are a trend can be divided in 3 sub-trends. Let's say, so a major trend. We got a trend. For him, we have an uptrend based on Dow theory, an uptrend, a downtrend. An uptrend is just as you can see, it's just a pattern of rising peaks and rising tops. Again, a downtrend is a pattern with successively lower peaks and tops. So we got this concept, so we know what is a trend for Dow. We'll see better the trend in the next lesson, but the idea, one way to find it, the trend, the Dow says that this trend can be can be divided in three parts. So we have and these three parts are: the major trend is the black one that is gonna last from 1 year to several years. Then we have a minor trend, secondary trend that it can last from is there from 3 weeks to 3 months, and then we have the minor trend, a short trend that it can last less than 3 weeks. So those are the descriptions of those trends. Those secondary and minor trend are just the correction of the respectively of the major trend and secondary trend. Something that Dow says, and then it applies to we can see later on when we'll be talking about percentage of retracement, so how much the price will set back after a rally. So this is the retracement. This one we see more in detail later, but Dow was just to let you understand that now the Dow and 100 years ago was giving those numbers. So the retracement of the price was generally between 1/3 of the wave of the rally and two-thirds. So it's 1/3 of this H and 2/3 of this H. Between those two, generally was 0.5, and it was giving that even the correction was supposed to be almost generally 50% of the always the previous rally, the previous wave, but this one has to be 50% of H. But again, this one it's always Dow. This was based 100 years ago theory. It's not always like that. Unluckily, it's not so easy as it looks. But otherwise, all of us, we would have been very, very rich. But it's not like that. So unluckily, it's not so easy as it looks. But we know that there is a range for sure. Has been this range on the setback of the percentage of retracement. But regarding this point, this one I think was mainly based on a trend line of 45 degrees, so that's why it was assuming 0.5 times half of this wave. But it's luckily it's not like that. It's not like that, and it's not so easy. But we'll see that in more detail later. I gave you some numbers, so please go through this number just to let you get confident with the percentages and how to calculate it, and then you will see that the retracement, the setback, it's between 1/3 and 2/3 of this distance, this H. Just please do it. I gave you some levels, I gave you some numbers, some lines there to help you to work out the percentage. This one is for you as exercise. As I told you guys, if you want to become good, you need to exercise, you need to read, you need to study a lot. Then let's move to the fourth principle. Fourth principle is that the major trend has three phases. The first phase is accumulation phases, where the most well-informed, or the very astute, very smart trader knows that something is happening, and so he starts buying, perhaps, or he can. In this case, then there will be a phases where everybody knows that the market is going up, so everybody starts investing into it. And then there is a distribution phases where everybody now knows, newspaper, economic news keep talking about this amazing bullish market, and then it's exactly the point is when the same acute investor, the same smart people starts to distribute or start selling or buy before anyone else. This is the three important phases of the market that we would like to get into this market at this point, because you can get a bigger margin. But generally, we are not. This is really expert traders. They can do that, or perhaps insiders. When the market will change, we need to know it to get in at this point. And then once we got it, we can go. We know once we got it, I think what Dow theory was aiming to get was not this accumulation part, but was more the public participation. So it was more was helping us out to find a trend. And once we have found a trend, we can start investing in the same direction of the trend. This is what Dow theory at the end tells us. So that's why it has been criticized, because it's not as quick as other, like perhaps technical analysis. It seems to locate the right time. It seems to work much better because it can give us the right time where to get into the market. While Dow theory it's more waiting that the trend is formed, and then we can go into the market. So we can lose generally 20-25% of our investment. And this is one of the points where the Dow theory was criticized, but because again, if you criticize this theory that was developed more than 100 years ago, so I think it's no, it's better that you read more about Dow theory, because to understand the goals of Dow theory before criticizing it. We need to recognize that it's totally changed. The market is totally changed from now 100 years ago. So let's move forward. The volume must confirm the trend. Just please read and memorize those definitions. But we will talk about volume in the next slide, next presentations. And then, but you can just read for now, and then just to get confident with these terms and terminology, and then a trend is assumed to be in effect until it gives definitive signals that it has reversed. So it means that the trend, if we have found a trend, it's most likely that it will continue rather than it will reverse. So it's like, if we have found a trend, the chance, the opportunity that the trend will keep moving forward rather than reversal are much higher than reversal. So again, read this definition and just memorize those definitions. Thanks. So now, talking about reversal, Dow found some reversal signal. So what you were saying, found the failure swing and non-failure swing signals for reversal, and those are some of the reversal pattern, let's say, that we can use. We need to memorize those reversal pattern. When we get confident with charts, we should be able to find similar situation, and then we say, oh look, I remember this chart, let's say this chart, this pattern, and then we can understand, we can recall that was Dow's pattern, and then we can say, oh, perhaps something is changing. This one is very intuitive. There is nothing really no intuitive, but if we are expecting the market to go up, we were expecting at this point C, this peak should be higher than the peak A, but it did not happen, so there is something wrong. So something is going to change. In fact, perhaps it can be seen as selling point as long if the minimum B is if this base is the bottom side, it's gonna be broken at the point S. If the point S is gonna be broken, this one can be seen as selling point or non-failure swing top. This one, perhaps this S1 can be seen as again as selling point, because the new minimum level, the new minimum level has been is going down, so it's not been respected. So because the D is lower than B, so again S1 can be seen as selling point, but or otherwise, if you want to be more, if you want to reduce the risk, you want to be on the safest side, S2 can be seen as selling point. So this is the concept. And then for sure a failure swing is much weaker pattern than a non-failure swing. For sure, this one gives more confirmation that we are more. Let's say that there is more. It's most likely that this one is gonna invert the trend rather than this one. So this one is more a strong signal of reversion of the market. So this is again we did for the top. It applies for the bottom. Just please read properly even this one, just to get a better understanding of these figures. That's why I wrote those definitions. And then the summary and tips. This one again, the main concept that we have been talking during this Dow Theory course. I hope it has been clear, and just those concepts bear in mind, because they are the fundamental, they are the foundation. Again, just to avoid confusion between fundamental and technical analysis, but those 6 principles are the foundation, are the basis of technical analysis. Thanks, and I'll see you to the next lessons.